Hello, friends. Welcome, and welcome back, I hope, to the Vestigo FinTech podcast. I'm Fraser Anderson. My guest today is Asiff Hirji. You can find him at Asiff Hirji on Twitter. That's at ASIFFHIRJI. Asiff has had a truly remarkable career as a technologist, operator, and investor, most recently serving as the president of Figure, a blockchain-based fintech lender. Prior to joining Figure, Asiff was the president and chief operating officer at Coinbase. Prior to that, he was a partner at A16Z and TPG Capital and the president and COO of TD Ameritrade. Asiff also held senior leadership positions at Saxo Bank, Hewlett-Packard, and Bain Capital, and has served on a number of public and private boards, including Citrix Systems. Asiff currently serves as a board director at Forge, a fintech-enabled marketplace for private securities, and is on the advisory board at Nubank and, most importantly, Vestigo Ventures. Asiff, it's nice to see you, and thank you for making the time today.
It's my pleasure. Thanks for inviting me.
So I'd like to start with a quote, and it is a quote from you, so I hope you enjoy it. It begins, "Go to the frontier because that is where the most opportunity and innovation is, and where the motivated and entrepreneurial congregate." And so I was hoping maybe you could comment a little bit on what you meant by that.
Yeah, I get asked about career advice. But first of all, thank you for digging up that quote. I get asked about career advice, and people always want to know, well, how did you get to where you get to? What should I do in your position? And one of the main challenges with that is everyone's different, and B, the world that I grew up in is different from the world that they're growing up in. And so the only advice I think you could legitimately give people is go to the frontier, meaning go to where technology is changing the fastest, where the industries are evolving the fastest, because that's where there's the most upside, right? If things are static, it's you're not going to be in a high growth environment. But if things are changing rapidly, I think you will be in a high growth environment. And that's so my only decent piece of advice to them, besides build a network, is go to where there's the most change, therefore the most opportunity, and that's what should create a more interesting career for you, and especially if you're an entrepreneur.
And I suspect we may be able to get to a situation in which you took your own advice when you joined Coinbase. I'd love to know how you got involved in that business.
Yeah, so I was a partner at Andreessen, and I had this odd role. My role was to help our best companies scale faster, right? So in ventures, as you know better than I, Fraser, you put 10 bets on the table, 7 are going to go bad, right? They're going to go to zero. There's not much value in making them go to better than zero, right? 2 will do okay, but 1 of those 10 is going to be the home run, and everything you can do to realize that value in the home run, it's worth anything you can do there. It's worth it. And so Mark and Ben at Andreessen convinced me that they needed somebody to help their best portfolio companies scale faster, and that was my role. And so I'd work directly with the founders to do that. And Coinbase was one of those companies where we had put in a check at $1.6 billion, expecting it to go to 10, and in fact it was going to 0. And so I was helping Brian, and it was a mess, right? So Coinbase, we could not reconcile cash to within $200 million. We on any given day, we weren't exactly sure what was in our trading wallets. There were a lot of issues operationally with the company. And so, long story short, it was okay. We need somebody in here to actually run it really, really day to day, so that we can scale as fast as we need to scale this thing. And the board, and Brian basically said, "Hey, what would it take for you to do this?" And I'm, I seem to be serially incompetent at retiring. So this was probably the 3rd or 4th time I was supposed to have retired. And so the arrangement I came up to is I said, "Look, I will come in, I will run the place, put out these fires, rebuild the management team, and get another funding round done to put us on the path of going public. And then after that, we'll kind of see what things are going. But my intention at that point would be to exit." And that's kind of what we did. And one of the pieces that I think is unrecognized is that if you have a high growth company, you recycle your management team probably every 2 to 2.5 years, because the company is growing faster than the people who are in the jobs can do it. And so that's one of the goals I had was, hey, put people in place that can take this thing public, because that's the right next step for it.
Are there any common patterns you look for, maybe at the individual level, or when you think about the team dynamic, that helps tell you when that time is? I mean, in our business, for us, it's always ideal when the founders just continue to grow into their next role, but that's, rarely the case. So yeah. I don't know if there's things you look for, or just is accepting the fact that it's going to happen, kind of 90% of the battle.
I think there's a lot of that, which is accepting the fact that it's going to happen. The caveat to what I said is you don't really want to replace the founder. In fact, that's a bad move, right? Most companies, once you replace the founder, their trajectories is very, very different. So the whole idea is you scaffold the founder with really good talent, and that talent, probably lasts in that role for, like I said, 2.5, 3 years kind of max, if you're growing very quickly. And the hardest phase is when you're doing it for the first time. So the Series A to B company type of thing, because it's the founder and a whole bunch of people who kind of were there from day one when it was like 3 people in a garage, to use the euphemism. And some of them they have a very hard time accepting that the company has outgrown them. Okay. And I should be clear, it's outgrown them in the role that they are in. There may be another role for them, which could be just as valuable, which is just as value accretive for the company, but it isn't the role that they're currently doing. And so if you were the head of engineering, maybe that's not the right role for you going forward. If you were the CFO, maybe that's not the right role for you going forward, but maybe there's a different role. And having that kind of conversation, and having that some people are comfortable with that, and others are just like, no, I need to go do another thing at a small scale again and restart it. And that's fine, because some people are better at sort of really small companies and startups. Some people are better at mid-sized companies, and some people are better at really large companies.
I do think it's probably about time in the interview to ask, given we've established, how Coinbase was when you joined. What on earth is going on in crypto today? Is it dead?
Yeah. No. So far, I mean, it's really frustrating. All we've managed to prove so far is we can do fraud better than just about anybody else, right? At least bigger than just about anybody else.
QED.
So yeah. So look, I'm a software developer by background, so I'll give you a software development, centric answer. Crypto or blockchain it's just a way to build an application. That's all it is. It's a way to build an application. And just like the last 2 major protocol-led changes gave us the internet as we know today, this is going to create the third. So the first one took us from the mainframe computer, which is kind of what I first was coding on. So we went from mainframes to distributed, right? So everyone got a laptop. You did stuff on a laptop, and it brought around self-serve everything, because it took the application off the mainframe where only certain people could get at it to a laptop where everyone could get at it. Okay, and so you had online everything. And then the next set of protocol changes came along, and we went from the laptop to a mobile phone. And now you had geolocation stuff, and you could press a button and a car would show up, all these kinds of great things that not possible before. Both of those changes, though, only affected the application. All we did was took the application, shoved it closer and closer to the user. We never did anything with the back office or the database that underpins a lot of the applications. This time, we're attacking the centralized database, because what blockchain does is allows you to take that database and distribute it across anywhere in the world. Right. And it does 2 things. It creates a global open source, completely public registry, which is read only, right? You can write to it, but you can't update, right? So it's immutable. People use this phrase immutable. Okay, which is great, because then you can have a public record of actually what happened and when, right? So that's number 1. And number 2, it allows individuals to settle and trade or exchange goods, if you want, completely bilaterally, because you don't need a central intermediary to handle that. Okay, so that means that you should be able to fundamentally rewrite sectors of our economy which are rife with intermediaries. And if you were to do an analysis and say, okay, what sectors have the most intermediaries and therefore the most cost of doing that, it would be healthcare and financial services at the top of the list, right? 2 of the most kind of data intense, centralized systems that we have and stuff that's running on sort of 1970s architecture, right? That's why it takes us 2 days to settle equity trades. That's why it takes us overnight to do cash transactions. It's insane. In this day and age, all of that stuff should be real time. It should, and by the way, it should cost no more to send money than to send an email, because all you're doing is messaging between two people, right? And yet we have all this infrastructure cost built in. So having said all that, it's just a way to build an application. That's all it is, right? But the difference is that when you build this application, you need a token to govern the network that you are building, this decentralized network of data. And in that way, that token is both the means of governance, it's also the means of exchange, which means it has some value. Okay. And so these companies, or protocols, if you prefer, when they go live, they basically have gone public day one. And this created a ton of speculation and a ton of value, and frankly, a ton of bad behavior. And so, in 2017, when you had the ICO boom, when I was at Coinbase, you had all these teams that would create a project that would make a lot of money and then disappear. Right? Nothing would ever happen because they made all this money, so they were not motivated to actually build anything, right? And so my frustration is we have not yet landed a use case that matters to the average person that makes crypto meaningful, right? We have store of value in Bitcoin, which is great, and we have the .NET or Java of crypto in Ethereum and or Solana, which are in others which are competing for that. But other than that, we haven't really done very much. And the epiphany I've had is I think it's going to be culture and not speculation that's going to create the use case that breaks through. And what I mean by that is it's not trading tokens. It's going to be things like music and art and entertainment and so on. That's how we're going to create a use case that matters to the individual.
Well, that does lead me to, I think, what I hope is a somewhat intelligent follow-up. And I know you've spoken about this as well, but just talking sort of personally, where I get stuck with crypto often is, when we talk about, platform shifts in the past, whether it's flagship pioneering, building companies on top of, the breakthroughs with the Human Genome Project, whether it's, Sutter Hill building companies on top of breakthroughs in database technology, the actual underlying technology is not really relevant to the product experience, right, or at least it seems to me. Right. So for example, Google Sheets doesn't say we are powered by cloud technology. And I'm now going to be somewhat provocative, intentionally, if not offensive, and start with a somewhat hyperbolic statement. But it seems that with blockchain applications, this alleged platform shift is the entire product experience, which is important because most of the products are terrible. So, what is going to change that? What is going to drive the adoption?
Yeah, no, it's actually a great question. And I would tell you that this is why I think culture and not speculation is going to do it. Because the people buy Bitcoin because they want a hedge, or they want something that they think is going to be a better store of value than whatever else they can do. So if you're in the third world, or you're in the developing world, to use a better term for that, you're in something like Venezuela, et cetera. If you've got any ability to transfer the money you are making in your job into something like Bitcoin, that's a safer move for you because it preserves value relative to keeping it in your local currency, right? And it's also a way that people can transact with each other. They don't care that it's crypto, right? They shouldn't care that, to your point, they shouldn't care that it's crypto, right? Just like we don't care that when we send an email that, I'm using the internet, right? No, I'm sending someone an email, right? And so this is why I say that if you have to explain that it's on crypto and it's using blockchain and all, you're losing. Like, that isn't the point. The person shouldn't know and shouldn't have to care. So let me give you an example where I think that works. If you had gone to Universal's theme parks this past October, being Halloween in the United States, you would have seen Halloween decorations everywhere, right? Of course, it's Universal. That's what they're going to do. And there would have been big QR codes all over the place saying, hey, win prizes, get to the front of the line here, et cetera. Scan the QR code and participate. And so if you took out your mobile phone and scanned the QR code, you were able to download, digital collectibles. You were able to get prizes for being in the front of the line, all these things that the people adopted and did. No one told them that it was on blockchain. No one said, hey, what you're getting is a wallet and an NFT, right? You shouldn't have to explain any of that. In fact, they shouldn't care. What they're into is the experience, and the experience is 10x better than doing it the old way, right? That if you're not creating a 10x better experience, then there's no point. The person's not going to adopt. And so I know I'm sounding like a broken record now, but the epiphany I had was those are the kinds of things that are going to get the average person into crypto much more tangibly than token speculation.
And you talked about a use case that worked, and you used the example of Venezuela. I think that's a somewhat popular narrative in crypto, that it's a store of value, and I mean specifically Bitcoin. And in places where they don't have a stable monetary regime like Venezuela, people will want to store their wealth there. At the same time, and I'm going to do some really hand-wavy arithmetic here, so bear with me. But I'm a VC. That's basically my job. About 65% of the world's population lives on less than $10 a day, and it costs around $1.15, I think, today to do a Bitcoin transaction. So assuming these individuals just make one purchase a day, that's 10% of their purchasing power, basically going back into the network. That seems impractical to me. Now, what I suspect is, or what I would postulate maybe is the case, is what they really want is USD denominated assets to hold and transact in, but they can't today. Do you think, does that bring us to a sort of a stable coin paradigm, or is that just sort of a silly... Yeah. No,
again, it's a super perceptive question. So first of all, your math may or may not be right, but directionally the point is right? But I would tell you that even in those environments, like look at sub-Saharan Africa, where the average income is even lower, people buy and trade cell phone minutes, right? So these kind of pseudo currencies already exist and circulate, right? It's harder for us in the West to grasp that, but they're there. And your point is exactly right. Given a choice, I think, between savings in Bitcoin and savings in USD, they would rather have savings in USD, right? Because it's something that everyone knows, everyone can easily translate, et cetera. So when I was at Coinbase, one of the initiatives we ran, we built a custodian, we built the international business, we did all these things to diversify out the revenue stream. But one of the most important projects that I helped lead was creation of USDC. So USDC was basically Jeremy Allaire of Circle and I on the back of a napkin sketching this out, saying we need something that would be a stable coin to drive transactions, because you can't have transactions on a volatile currency. We can't rely on Tether because no one knows what it is or how it's backed, right? And my own prediction is Tether is going to go the way of FTX and Binance and everything else. So let's create one, and let's create it as an industry utility. So it's not the Coinbase coin or the Circle coin. It's something that the industry will adopt. That was the original premise behind USDC. And you will see and are seeing savings and lending in the developing world that is stablecoin backed, right? That is stablecoin deposit backed. And the transaction costs on stablecoin are much, much lower than the transaction costs on, say, Bitcoin, right? And especially ones that are not on Ethereum, because the Ethereum gas fees are really high, just given the amount of volume. So there's, stablecoins on other protocols, USDC on other protocols, where this is being done. I would point you to Stellar, for example. Stellar, I think, is a really interesting company, organization. Most of the old guard would know what it is. Most of the new guard would say, I've never heard of it before. But this is a crypto protocol that basically bought a big chunk of MoneyGram. MoneyGram being like Western Union, one of these companies that you use to send money to your relatives abroad, et cetera. And it's helping drive down the costs of that by using wallets and stablecoins. And so that's a real world use case, I think, that's making a lot of value. And people, again, for the average user, do they need to know it's crypto? No, they don't care. They should just say, hey, it's US dollars and it's cheaper.
And I do think this is important. So I'm going to beg you to indulge me by doing kind of a definition. Could you talk about what a stablecoin is? In layman's terms.
So to me, a stablecoin is simply a representation of an actual US dollar. Okay, it's backed 1-to-1 by that dollar, and it's redeemable by anybody who chooses to accept it for that dollar. What I mean by that is, We've had digital money for years, right? Like, most of us, we pull up an app and look at the bank account statement and balance on our apps and whatever. That's a digital representation of the money we have, okay? And most people don't realize this, but if it says you have $100 at the bank, you actually don't have $100 at the bank. What it means is the bank owes you 100. What the bank has done is it's lent out that 100 to other people because it earns money on that. So if all of us showed up at a bank and said, "Give me my money back," the bank would go under. That's known as a bank run. Okay. Sorry for being slightly technical, but the difference between that, which are hypothecated deposits, the difference between that and a stablecoin is that the stablecoin deposits are actually there. So if everybody who owned USDC showed up at a bank and said, "Give me my money now," everyone would get their money. There would not be a run on the bank. The banks would not fail, et cetera, because these things are one-to-one backed by design. Okay. And so this is the way we had originally set it up. So a stablecoin has two properties very different from what you and I currently consider stable as digital cash. One is it's immediately redeemable and not hypothecated, and two is it's programmable. Okay, why does that matter? Okay, we've never had programmable money before. Now we have programmable money, and what programmable money does is it allows us to do things we couldn't do before. So say, Fraser, you and I, maybe we're both basketball fans. Maybe we're going to bet on the outcome of a Warriors Celtics game, right? You live in Boston, I live in San Francisco. I
can always use more money.
Yeah, exactly. I might be a deadbeat. You might be a deadbeat. If we make $100 bet, who knows? There's a risk that we may not even collect, right? But if you've got stablecoin, you can actually write a smart contract, very simple smart contract that says, "Hey, if the Celtics win, move $100 from Asiff's wallet to Fraser's, and if the Warriors win, move $100 from Fraser's wallet to Asiff." And when that smart contract is invoked, it actually locks the $100 in your wallet and the $100 in mine, so that we can't go spend it somewhere else, right? That's a really powerful concept. That now you have programmable money, right? And this again goes to, how do you reduce the costs of financial services? Our financial services that we take for granted are actually quite expensive, right? Relative to where they were 100 years ago, they're cheap, but relative to where they could be given the technology we have today, they're still super expensive. So using things like programmable money is going to, again, drive down the costs of these transactions. And that was, the bet is just a simple, trite example of how you could use it.
And do you think there are, or maybe not, do you think, are there inherent advantages to a USDC versus what I sort of suspect the future is going to look like, that at some point the central banks are going to create a central bank stablecoin and it will be programmable, but it won't be decentralized at all, I would not think.
Yeah, look, you could do that. I know the Chinese are very keen to do that. So there are a couple of issues, some economic and some social. So the economic ones are, central banks are not in the credit creation business, right? So, it's the retail banks that do credit creation, or the wholesale, the institutional banks that do credit creation. So again, go back to, if I put $100 into my bank turns around and creates credit. It loans some or all of that out to other people. The central bank doesn't do that. That's not its mandate. It's not a charter. Doesn't have that skill set. So I think if we go down the path of a central bank digital currency, and we could, what I would think is going to happen is the central bank digital currency is going to exist between banks and the central bank. And they will borrow and lend each other central bank digital currency. And then each of the banks will be an issuer of and an acceptor of a different type of stablecoin, which is redeemable at that bank or across a bunch of banks. Okay, I know that sounds a bit mind blowing. It's not different to the way the banks used to work like 100 years ago or so, but that is how you will create credit. And if you do that, it's actually really easier to comply with the Basel rules. Or you remember the Archegos thing where it blew up because no one knew how much that everyone had lent, right? But in this new world, you could look up Archegos as an entity, and you would see that Archegos as an entity had taken loans from 10 different institutions for 3 times the amount on its balance sheet, right? Because you can track these things in a public register in a way that's open to all, right? So that's where I think it's going. That's the technical one. The social one is, if you have a central bank digital currency and it is the only issuer and the only source of credit, you are now completely dependent on the government for anything financial, which is where the Chinese government wants to go, because then you can create social engineering and say, hey, if I don't like what you said, if you criticized, the totalitarian chief in charge, I can turn you off. I can literally write you out of the financial system by one click. And that's, now we're into worlds like 1984 and complete dystopian futures and so on. And I certainly wouldn't want to be there. So I would hope that if we go down the central bank digital currency path, it's the central bank digital currency is the thing that banks and the central bank use against each other. And there's still this other stablecoin that's used more broadly.
And on the topic of sort of regulatory shifts that will transform the way we sort of do things today, are there other items sort of on the roadmap that you see as really important in the coming months, years?
So one of the things that we really suffer from is we don't have regulatory clarity. We as an industry in crypto do not have regulatory clarity. Like every single regulator wants to lick the cookie and say this is mine, right? So the SEC says these are securities. FinCEN says these are currencies. The CFTC says these are commodities. And they all come up with sets of rules, many times that are in conflict with each other in terms of what you can do. And so trying to navigate this regulatory morass is really hard. That's number one. Number two, regulation was already pretty much screwed up in financial services before crypto came along. So for example, Figure, that one of the companies I was just with, we do home lending. We do home equity lines of credit, okay, to consumers. It sounds like a simple business. Okay, to do that, basically lending people money, you need a license in every single state as a money transmitter and a lender. Okay, so now we have something like 100 licenses that we have to maintain, lending and money transmission, right? That we get regularly audited on, et cetera. It's a super heavy, complex way to do what is really a pretty simple task. And so, unfortunately, these government bodies, they only go one way. They only get bigger. I think Ronald Reagan was the only person to actually reduce the size of government, right? Because it is not in their nature to say, oh, you know what? I'm too big. I'm too fat. I should cut that never happens in government. And so every year, the regulatory complexity goes up, not down. And so I would hope that in the same way that crypto will do a reset on a lot of the way financial transactions work, we will have a bit of a reset on regulation. That might be a pipe dream, but I'd hope so.
And I was speaking to some crypto friends saying that, I was going to have you on the podcast, and some folks wanted to know how you think about sort of the centralized exchanges in the States that are regulated already are going to be even more regulated. And they're going to have to compete with the folks internationally. Does that matter? How do you think about it?
So first of all, they already compete with the folks internationally, and secondly, it is a totally unfair regime. So Coinbase and Kraken and others are regulated in the United States as financial entities in the United States. Okay, Coinbase is public. Coinbase is audited. It has audited financials. There's a big four that does that, right? Completely so you can tell immediately what's on the balance sheet of Coinbase and how solvent it is and everything else. That is in complete contrast to, say, at Binance, right? You cannot tell anything about Binance. First of all, doesn't comply to any normal regulation in the United States. It doesn't have audited financials. It doesn't have public financials. It is basically not far off what FTX was, right? A completely black box that people trade on. And why do people trade on that? Well, they do it for three reasons. One is there's a bunch of assets on there that you cannot get on Coinbase. Why? Because they're too sketchy to be on Coinbase. So there's a bunch of assets that are out there that people want to trade. Great, you trade them. Most people who are smart do not keep a balance on Binance, right? Because if you keep a balance on Binance, you run the risk of what happened at FTX, that at some point it blows up and your assets are stuck. So that's one reason to trade there. The second reason to trade there is you're not in, you're in some country where the only access point you have is something like a Binance, right? Because Coinbase doesn't exist there, or the regulators have said you can't do it, and so you're using a VPN out of China to trade. That's the second reason. And the third reason is because you are looking for a venue that does not comply to U.S. laws, right? Because you're doing money laundering or whatever else it is, right? And Coinbase has all these rules that it complies to in regulations around money transmission to it's called OFAC, to make sure that it's not money laundering, that it's not North Korea doing it, that it's not Iran doing it or something else. None of those things exist at a company like Binance. It just doesn't care, right?
I'm going to definitely ask a little bit more about FTX if you don't mind. Yeah. First, I was reading an article the other day about how SBF is fighting for hundreds of millions of dollars of his assets which have been seized, and it struck me that this is one of the great ironies of all time, that the self-proclaimed crypto genius is in a cash crunch because he's obviously completely not self-sovereign. So what narratives are there that are particularly egregious around self-sovereignty in crypto that would apply here?
So I think some of the lessons that people are going to take away from the FTX is, first and foremost, the old trope of not your keys, not your crypto, right? So I think self custody is going to become much more prevalent. The issue with self custody is just way too hard, right? Trying to get people to remember a 12 word seed phrase, and if you lose it, all your assets are gone. Like that is not a user experience that we need to live with. And so I think there are going to be major advances in how self custody works, such that people can much more easily self custody their own assets. So that's one thing. I think two is people will move to a model where they do not store their crypto on an exchange or on an entity that's taking primary risk. So one of the first rules we laid down at Coinbase when I was there was, we are an agency-only business. We are not a market maker. We are not a prop trading shop. We are not going to be on the other side of the trade. It's one of the things I took away from my time when I was running Ameritrade is that you don't want to do any of those things. First of all, the market doesn't value them, right? So if I went to become a public company with those kinds of businesses, I'd get very little value for them. And secondly, they're an excellent way to blow the place up, because guaranteed, right, someday something is going to happen in one of those black box trading algorithms, and your company's dead, right? And you just don't need to do that. So number one, I think self-custody. Number two, I think people are going to be much more discerning about who is an agency-only model versus a not agency-only model. And number three, you will see the growth of crypto custodians much faster, I think. So Coinbase Custody being one and Anchorage being another. I think institutions especially will store much more there and trade at exchanges without exposing their assets, or a lot of their assets, out of the custodian.
The next question, I think, is benefits from perhaps, at least speaking for myself, that the sort of salacious nature of the FTX revelations just mean they're kind of endlessly entertaining. So I don't think you can go on too long, but could you comment about what happened at FTX? Especially if you knew Sam personally.
So look, I don't. Yeah, I've met Sam a number of times. I met a number of his right-hand people a number of times. I actually was an investor in FTX, full disclosure, from pretty early days. You can't protect entirely from just outright thievery and fraud. Right. Like that does happen. I think the failing, and if I was an LP in a major venture fund like a Sequoia or something like that, I think I'd be having some very hard questions to my GP about how is it you made this investment and you didn't really look at any financials, and you didn't really look at what was on hand, or you didn't really look hard at the business model. Like, how is that possible? Okay. Like, if I'm making a seed investment into that kind of company and something like this happens, that's like, okay, fine. At the seed stage, you really didn't know much. But if I'm valuing this thing at like 30, 40, $50 billion and I'm putting money into it, you would think that I would have had, at least the basic financials down and the basic business model down, and would have had a pulse on kind of what was going on with the assets. And so I think there was a major sort of failing in the diligence that a lot of the growth stage investors did. And by the way, the entire sector, I think, got overhyped if you think about the valuations that we were running at. But my personal view is they committed fraud. They should go to jail, right? I don't care if the terms of use said that they could use the person's assets. Like, there's no way that any business should be allowed to take, multiple billions of dollars of customer assets, go long, bet the market on it, and lose. Like that's a Ponzi scheme, right? So that's not that's not something we should just sit there and say, oh, tough luck. That's an investor's loss.
My suspicion of kind of what happened on the VC diligence side is, I think, a combination of velocity of deals in the past few years combined with, I suspect people just kind of lost the chain of custody of who did the original diligence. That it was, pick a VC. They did the last round. Like, we don't need financials. Like, it's just, it's growing at this rate. We don't need the audit trail, which is obviously not an excuse, but I think an unfortunate market dynamic, which is fortunately getting corrected.
There's definitely some of that, because the other thing about venture is so I've been a partner in a PE shop at TPG Capital, and I've been a partner at a venture shop. And one of the big differences is, in a PE shop, the worst outcome is your investment goes to zero. Like, you lose money, that's the worst outcome possible. And you do everything to avoid that. And so that's why you do tons of diligence and everything else. In venture, it's not that your investment goes to zero. I mean, 70 or 80% of your investment is going to go to zero. The worst outcome is you missed on the one that was the 10x or 100x return. Okay. And so the FOMO in venture of missing out on a deal is gigantic. And so rational. I think it is rational, but it's gigantic. And I think so. I think especially when the market's super hot and deals are getting done in so people prioritize speed, right? I took this. Why did you take this VC or the other? Because he said or she said that I could get the money tomorrow as opposed to 2 weeks from now while they do diligence, right? So speed becomes an issue, size of check becomes an issue, level of diligence becomes an issue, and I think the bar was lowered to the point where we allowed some of this stuff to happen, which is, it should be a real reset for the industry. And will it be? Probably not, but it should be.
It'll be for a little bit, maybe.
Yeah, and then people will forget.
So Twitter is a wonderful thing and a horrible thing in a lot of ways. But more specifically for this interview, it's been great because your Twitter is actually a bit of a trove of gems. And I wanted to read another one of your tweets and have you unpack it a little bit, because it sounds quite clever, but I don't quite know what you mean.
That's Twitter. That's Twitter right there. Right? Sound clever. Don't actually say anything specific.
Yeah. So. You don't often have to explain them on a podcast, but here we go. So here's the tweet. SBF interview is a reminder that how you think about something is more important than what you think about it. So can you unpack that a little bit?
Yeah. So it's, to me, people are quick to judgment, right? Very quick to judgment. And they read about the fact that, this person made enormous amounts of political contributions, or a lot of the headlines in the beginning were, oh no, this major philanthropist just got in trouble, and now the charities and other things that he donated to weren't going to get the money. Like, that was the headline. The headline wasn't, this guy just screwed millions of people out of their money, right? It was, oh no, and so to me, this is an example of the frame that you use to analyze something is much more important than the outcome of that analysis, right? Because the outcome of the analysis is bullshit if you didn't apply a rigorous sort of framework in the beginning. Like, otherwise you just post-rationalizing, right? You're just saying, I have this preconceived notion as to what the answer is, and I'm landing on that. That's what I mean about, it's much more important how you think about it. Like, what questions did you ask yourself? What analyses did you go through? Than what you ended up as a result, therefore thinking about that situation. Does that make sense now?
It does make sense. And is what you talked about earlier about management teams being outgrown by the company, and the distinction between the company has outgrown you and the company has outgrown the role that you are in, or the role that you were in has outgrown you, maybe. Is that an example of that kind of framing? Yeah,
exactly. So it's not that the 3 or 4 co-founders no longer should be with the company because the role they are in has outgrown them. That just means that somebody else should be in that role. But they could have, amazingly impactful roles elsewhere in the company. And you've seen that happen. Like even you were mentioning Twitter, that happened at Twitter, it happened at Yahoo, it happened at other places, right? There's loads of companies that's happened to. So it is not the case that just because the company is growing super fast that the founders all have to leave, that the co-founders all have to leave. No, that there's other roles they could go play.
And another thing that you talk about quite a bit, I think, is how essential the macro is in any meaningfully successful investment. Mark talks about it a lot as like, what's the tailwind? And, I think you've alluded to it already, and I think we've talked about it. Maybe crypto is the macro shift, but are there other macro shifts that, frankly, I should be aware of as we go out and try to make investments?
Okay. So when I was at Andreessen and at TPG, we would do a lot of retros on why did this deal go well or why did that deal go badly, et cetera. And the number one reason for private equity, for sure, the number one reason of a successful deal was you got the macro call right? It wasn't necessarily the management team. It wasn't even that particular company. You got the macro call right. Like we were going into a recession or we're going into an area of growth in cloud or whatever the macro call was. So that overlay is there. It's really tough to have a winning investment that's counter cyclical to the macro. Today, I think I would sit there and say, okay, well, what are the trends that I would be looking at? I think one of the trends I would be looking at is the growth of machine learning. I don't like the term AI. I don't as a computer scientist, I don't believe in artificial intelligence in the sort of classical way, but I do think you'll get machine learning to the point where it's indistinguishable. And ChatGPT is a great example because it's easy for most people to use and understand, right? So I think you will have machine learning applied across the board in a lot of use cases, and it's going to take a lot of the human labor element out of a lot of what we do, and bringing costs down and bringing service up. I think that's a real trend that's going to happen, right? And everything in San Francisco today is AI. It's like become a flavor of the week, right? I do think crypto is still relevant, and I think it's relevant because it's, as I said, it's a way to build an application. We've just fumbled with how to get it to a point where it matters to the average individual. And then the other ones that I would think about are there is some combination of virtual reality and especially bioengineering or healthcare, genomics, et cetera. I think that's where the frontier is. When I was growing up, it was computers. I think today it's going to be more biology. And so that those are the areas I think that are going to have the most interesting sort of outcomes in the next decade, 2 decades, 3 decades. You've alluded to your experiences. We talked about
many of your experiences on the intro, and you've had a lot of them. Which firm or which firm did you operate at, which had the best culture?
Great question. So I would tell you that I really enjoyed my time, believe it or not, as a consultant. I know that sounds really weird, but McKinsey and Bain and those kinds of things, because they had a really amazing high performance servant leadership culture. It was about getting the right team together, giving that team the right resources to get it done, and then just getting out of their way, letting them do stuff. And it was very from a cultural point of view, it was amazing. And I would say Ameritrade was very different as a type of company, and yet it had an amazing culture that was quite similar to the consulting environments, in that it was a team-based culture. It was based on getting the collective problem done. The manager's role was to equip their teams to get the job done. If things went wrong, it was the manager's ultimate responsibility. If things went right, it was the team's result. Like that was the kind of culture it was at. And I would contrast that to, without naming names, a lot of the venture funds and a lot of the private equity firms that I've been part of have a very different type of culture. It's a very Wall Street kind of culture, which I think is much more individualistic. It's much more competitive. It's much more, the pie is a fixed size, and I got to fight for my piece of the pie. And if I get a bigger piece, you're going to get a smaller piece. And I didn't really enjoy that. I'm much more I'm much more of a, if you know the servant leadership model, I'm much more a fan of that kind of structure and culture around how you build a company, how you equip people, how you train people, how you motivate people, that kind of thing.
I'm delighted that you mentioned TD because we're FinTech fans here. You are a FinTech OG. I hope I can use the term.
Yeah. For sure. Yeah.
Can you talk a little bit about what that experience was like? And,
sure.
When you look at the landscape today, do you feel like we've come very far, or does it feel like, wow, you've spent a lot of money, VCs and operators, but,
Look, I think so. The TD situation was really special in that there was a company along with others that realized that there was deregulation in the way in which stocks could trade, and that there was a far better way of delivering that service to the individual, right? Because prior to TD and others coming along, to Ameritrade and others coming along, you would spend $50, $60, $70, $100 to trade a stock at a Merrill Lynch or at somebody else. And you could do it for like $8 at Ameritrade or 10 at E-Trade, et cetera. And so it democratized investing in a way that wasn't possible before. That's number one. And I think that it led to the expansion of equity ownership in the United States, which I think is a good thing. The time there, though, was, 2001 had just happened. The world had ended. Literally, the NASDAQ went from 5,000 to like less than 2, right? So tremendous amounts of value was eviscerated. And trading volumes just went into the dumper. And the one thing we had, though, at Ameritrade was we had the lowest cost infrastructure. We had the lowest cost platform because we'd invested heavily in it. And our view on that was, okay, if we really have the lowest cost infrastructure, we should be the one who rolls up the industry. We should go out and acquire these companies and move their customers onto our platform, because that'll make more money. And our rule was pretty simple, which is if you could buy a company, retain 90% of their customers and revenues, and cut their costs more or less in half, that's a great business. And that's what we did. We did that like 6 or 7 times. We did the biggest deal in the industry every single year for 5 years. And we grew it from a $4 stock when I showed up to a $24 stock by the time I left. And so I think that was a great period of expansion and value creation. And the industry is now consolidated. And we had, when I was there, we had a deal to buy, we were going to buy Schwab. And that deal fell apart because of literally an argument over how long the name would have to remain Schwab. And fast forward to a few years ago, and that deal got done in reverse. But yeah, it was the right outcome.
And so after TD, you went to the dark side, and I'm asking purely selfishly because, especially for venture capitalists of my vintage, though I think for all venture capitalists, the siren song of operating, is very sweet, especially when the markets are hot. So it's probably less sweet now. And then you went back to operating. So if you'd share your thoughts on, the experience of operating in businesses, investing in businesses, and how to think about those pieces. Yeah.
So unhelpfully, I think it all depends on what your nature is, right? Some people are by nature operators. They want to own it. They want to drive it. They want to build it. And some people are by nature more investors. What I found was that I'm this weirdo that I like companies that are going through an inflection point, and in a very short period of time, they could either create a lot of value or die, right? And that was what I was attracted to. And, Ameritrade was a great example of that, where it was a $4 stock going to zero if we didn't do something. We were like, here's a plan. We're going to execute on the plan. And we're going to go do it. And we did it. And we created a ton of value for ourselves. And I went looking for more of that. And you have to remember at the time, I had Silver Lake and Bain Capital and TA Associates on my board at Ameritrade. They were investors in it. And so that's how I got kind of a picture on what private equity did. And so I went into private equity, and I had this bizarre role where I would help the investment partners, formulate the thesis on a particular thing. And if we were successful, I would be the person on point to drive the investment thesis with the company. And there's pros and cons to that. We created a bunch of value. And what I found was that I liked that approach, but I didn't like doing it in a firm. And so when I left TPG, I set up a family office. We have a family foundation, and I do a lot of investing through that. But my investing is much more hands-on. Like I act as an advisor to most of the companies that I invest in. I help them, and that's Figure is an example. Sometimes the company is special enough, and the situation is special enough where the founders and I can see, hey, if we were to do these things, we could add a zero to the valuation in a short period of time. And so I step in to help do that. So there's not a generic answer. I think you have to know within yourself what motivates you, what gets you out of bed. And by the way, there's some operators that are great at like the 3 to 5% growth companies, and I take my hat off to them because I can't do that, but they are amazing at doing that. And there's some operators that are like turnaround operators or inflection point operators, and they are crap. Like I am miserable at like grow the company 3 to 5%. Like I can't do that.
This does get me to another question, which you sort of suggested to me over email you weren't going to answer, but now that the camera's rolling, maybe you will. What is next? How are you going to fail retirement again?
Oh, again? I feel like there's unfinished business in crypto. I feel like we still haven't proven that it's worth anything for the average person. And if you couple that with my point about, I think it's going to be culture that's going to be the breakthrough and not speculation. Like I'm spending more time with companies in that space. So there's a company called MoonPay, for example, where, that universal example I talked about, MoonPay powered all that, right? MoonPay powered all the infrastructure end to end. And so I do think that there will be a series of companies, crypto infrastructure companies that grow up that help enterprises by that I mean like a Nike or an Adidas or a Universal or an LVMH, et cetera, connect to their audiences better than they currently can and create more of an intimate sort of relationship and more value for the brands and their consumers. And I think that is where crypto is going to prove its use case. And so this is where I'm spending more of my time now is how to get that thesis to play out faster. Okay.
You've been kind enough to answer a number of questions about which I can at least pretend to know something about. So we're going to shift into there's a working title for this section, but today we'll call it Swift Inquiries, but it's basically short questions. Because we'd love to leave the audience with something, maybe something a little bit less anchored in FinTech that can give them an insight into your thinking. So I'll start with what piece of media, it can be a book, podcast, movie, article, essay, have you gifted or shared the most?
Okay, so it starts with which one had the biggest impact on me. And I would say that, reading Atlas Shrugged as a kid, like blew my mind. And reading Guns, Germs, and Steel, not much later, also blew my mind. And so those are probably the two things that I've given out more of to folks than anybody else is, hey, read these as just a way to reframe the way you think.
And what's the last idea that you encountered that blew your mind?
Really, it was AI. And by that, I know it's a trite answer, but the machine learning around ChatGPT, for example. So there's the OpenAI movement and everything else. We through our foundation are funders in how do you create a rule set to help govern AI so it doesn't have a bad outcome, right? And there's three things people focus on. One is, well, garbage in, garbage out. So how do you make sure the training data is right? Okay, and we spend a lot of time on that. The second is, well, I want a set of rules that I'm going to impose on top of AI to make it come up with the right answers. I hate that because then that means that you've centralized the decision making. You've centralized, who's going to make sure that rule set isn't biased, right? And then the third is you focus very much on the actual algorithm as it applies to the data to get to an answer and make sure it's traceable, so that if you come to an answer that was like not unexpected, you can actually trace back just like you would through a debug log of based on the data, how did you get to this answer, right? So I'm spending most of my time on those two things in AI, which is how do you make sure the data's clean, how do you make sure the algorithm works, and what blew my mind is there's a lot of cases, especially in medical research, where the algorithm makes predictions based on, like, for example, X-rays, that a human doctor would never have come to that conclusion, and yet it's the right conclusion. And so it's mind blowing that it's showing us different pathways of making those decisions that we just wouldn't have thought of ourselves.
And how generalizable do you think those components are? Because for me anyway, when it comes to machine learning use cases, it's all about the consequences of the decision. If the decision is going to pick what ad to show you, then we need the kind of most rough and ready set of rules because the consequences are high. If it's triaging in an emergency ward, that's a different story. What do you think about that?
No, I think that's right. And I would go back to people try and govern that in those three ways, which is around control of the data, control over a rule set that's imposed on top of the outcome, which I think is bullshit, but that's what people do. And then the third is making sure that the decision making was traceable, like that it's auditable. And in both those cases, I would want, especially the triage one, I would want to have the thing say, take that person, not this person. But I'd want a human to trace through the log of how did it arrive at that, and was that really the right answer? Right. And if it's not the right answer, it's probably because the data was wrong. It's not because or maybe the algorithm doesn't weight something appropriately. It's not because we need a rule set to govern it better.
I love that that sort of machine optimized human, but the morality still sits with the human. That's a wonderful framework. So who are your mentors? That's my last question.
That's a good question. So I ask this question actually when I do manager training, which I say to people, think of the person who had the biggest impact on you in terms of, it could be a coach, it could be a teacher, it could be a mentor, whatever. And what did they do? And are you doing that to your employees? And if not, why not? And the answer is almost never that they're doing it. But I would tell you that I was fortunate that I had several mentors throughout my career. I had a great mentor when I just started working who, showed me that you don't want to be the smartest guy in the room. You don't want to come across as being the smartest guy in the room. That's a great way to get your head kicked in, right? There was another mentor, Joe Moglia, who ran Ameritrade, who he's a football coach by background. He's literally a football coach who went to Merrill Lynch, and he has an ability to fire up the average person in a way that I've never seen anyone do before. And how to connect in a very authentic way with anyone from any background. That was amazing. And the third was really the people at Bain, when this whole concept of servant leadership, which is one of the things they believe in very passionately, came through. And it was look, the manager is not the person who gets credit for the outcome. The manager is the person who gets the blame if the outcome is bad. But it's the team that gets the credit, and this is how you think about managing. And so I would say that those were three enormous resets, kind of the way I thought about how to grow my own career or be a manager or drive myself going forward. And I'm eternally grateful to them.
Asiff, thank you so much for your time. It's been an absolute joy to have you here. I was somewhat nervous about this because Mark did warn me about your somewhat frightening intellect, but I've had a lovely morning, so thank you.
Good grief. Okay, I'm not sure. Anyway, say hi to Mark for me. Thanks for inviting me. I appreciate being here. Okay, take care.
Thank you. Bye.
Bye-bye.
Hello again, friends, and thank you very much for listening till the end. One final thing before you go. If you enjoyed this episode, do you think you might also enjoy a monthly email from us where we share more stories, news, and perspectives from our early stage fintech ecosystem? If you think the answer might be yes, head over to our website, vestigoventures.com, and sign up for our Envisions newsletter. In addition to blog posts with our latest thinking and updates from our portfolio companies, we always include a short video interview with incredible people from our network. If you do sign up, I hope you enjoy it.